From Plano, Texas, Good Morning CCAR. With your host, Scott Dresanopoulos, Tish Ashanopoulos, Sam Brockanopoulos, Julie Nicolanopoulos,
and weather with Joe Boganopoulos.
Welcome again to Good Morning CCAR, August 11th, 2015. We've got a big show lined up for you that will be fun and interesting, focusing on lending topics that directly affect realtors and their business. We'll start with headlines, then get some entertainment news, the weather, and we'll even have a special report from Tish on the scene. Now for today's headlines. The Department of Housing and Urban Development has announced sweeping changes to FHA financing. First, FHA appraisals will be more intensive on property condition and photos required. This means that extra work will be involved, and as a result, it's expected that fewer appraisers may even choose to do FHA appraisals. This could be a pretty heavy impact on realtors and lenders alike, because they're going to have to do a lot more intensive inspections of properties than what we've been used to lately.
You know, Scott, another change that FHA has made is the reinstatement of the 90-day anti-flipping rule. So after a hiatus of the past couple of years, FHA has reinstated that rule. And what that means to borrowers is from the day you take title to that property, you are not allowed to enter into a sales contract for at least 90 days. So it's very important to understand that's not close on it, but enter into that contract for not less than 90 days after you take title to that property. You know, FHA had suspended that rule to try and help spur the housing market and get rid of a lot of those foreclosures that were sitting out there, and I think it's done the job. So
it has done the job. Inventory of those foreclosed and distressed properties is certainly down. But one thing that our realtor community needs to keep in mind is, historically, when you see a property listed that says FHA ineligible, immediately you think of roof issues, foundation issues, structural issues that you know won't pass an FHA appraisal. And now, that could potentially mean that the seller has been on title less than 90 days. And that's why it's not eligible for FHA financing. So it really puts it upon you, the buyer's agent, to investigate and find out exactly what the issue is with the property that you may be interested in, rather than just assume it's a structural issue.
We should point out, though, that FHA is still a great program for the right buyer, especially for someone with a low down payment or credit blemishes or even a higher debt-to-income ratio. And typically, the FHA interest rates are a lot lower than the conventional rates as well.
that's right.
In entertainment news, we caught up with Fannie Mae, and she seems to be up to her old tricks of making changes again. This time, though, some of the changes are actually positive and help the buyer. Credit cards are no longer required to be closed when they need to be paid off prior to closing to qualify for the mortgage. They can remain open with a zero balance. Unreimbursed business expenses on Schedule A of the tax return can now be ignored unless the borrower's income is 25% or more commission. There are also two changes concerning converting a primary residence to a rental property. The first one being the minimum reserves have been reduced from 6 months to 2 months. For those of you asking what reserves are, that's money that's left over in the bank after closing. There's also no longer a minimum equity requirement in the property in order to convert it to a rental property. Previously, Fannie Mae required a buyer to have 30% equity in their current home before they could use any of the rental income to offset that mortgage. Additionally, changes include 100% of non-retirement equity securities can be used to qualify for the mortgage, those stocks, bonds, mutual funds. Previously, Fannie Mae only allowed lenders to use 70% of those balances in order to be conservative and account for market fluctuations. And finally, some good news with condos. For a primary residence purchase, we can use the less stressful limited condo review process for minimum down payments as little as 10%. Previously, it required 20% to avoid the grueling full review process.
Those are great changes, and you know what, you've been chasing Fannie Mae. I managed to catch up with the more elusive Freddie Mac, who seems to be chasing Fannie and making some changes of his own. So some of the changes include a increase to the maximum finance properties of 6 with Freddie Mac. That was previously 4 properties. Of course, if you have more than 6, you can still go over to Fannie Mae and do up to 10. The other thing they've done away with is the 2-year experience required on rental property. So that's going to make it a lot easier for a first-time investor to use Freddie Mac for that financing. To go hand in hand with that, no rent loss insurance is required moving forward. That's been a big topic, and now, especially a first-time investor no longer has to have that rental loss insurance. And finally, in instances where the credit report does not list a minimum payment for student loans, Freddie Mac has matched the Fannie Mae guidelines, and we are now allowed to use 1% of that balance as the minimum payment.
That's great.
Those are all good changes.
Well, and then they made these changes that certainly, sound like they may be, trying to be a little bit more aggressive, a little slightly looser on credit guidelines, but they've also made some changes simultaneously. The biggest of which, from the rate standpoint, is they've removed the adverse market delivery charge, which used to be charged on every loan that was delivered to either agency. Those have gone away, but what they've done instead is increase and change the loan level pricing adjustments for each loan.
Explain again what the LLPAs are, Sam.
Loan level pricing adjustments take different criteria on each loan. For instance, the credit score, loan to value, occupancy, existence of a second lien, property type. Each one of those has a bearing on, combined with all of the other attributes, on what sort of pricing is eligible and available for the borrower on each loan.
And some of those price hits are significant. I looked at a couple recently, and for instance, for an investment property, a borrower putting 20% down now gets hit with the equivalent of 3.875% in discount points. So you either have to pay that or it has to be absorbed in a much higher rate. The other thing we're starting to see is a pretty substantial hit for secondary financing. So the borrower that wants to do a piggyback loan at an 80-10-10, for instance, they're going to see a lot higher rate on that first lien moving forward.
There are rumors about Fannie and Freddie hooking up. Even though they're making independent changes of each other, we don't know for how long before it'll be all combined and rolled into one.
So in your opinion then, who is the looser of the two?
Looseness or lack thereof is certainly kind of arbitrary. It's going to depend on the scenario. It's going to depend on the borrower, the property, and what type of loan they're trying to do. For instance, Fannie Mae's DU, automated underwriting, is going to approve certain things that Freddie Mac's LP underwriting system is not going to, and vice versa.
So, additionally, some lenders can switch back and forth between the Fannie and Freddie programs. So if a loan starts out as a Fannie Mae and then along the way there's a violation of one of Fannie's rules, we can look at switching it over to a Freddie Mac rule. Not all lenders are capable of doing that.
And now for our 100-year-old birthdays of the week. I'd like to say happy birthday to Roberta Baker, a handsome gal of Plano, Texas, celebrating her 108th birthday today.
Happy birthday, Bob.
Happy birthday, Bob. And also Randy Wright from Plano, Texas. The Joker is celebrating his 103rd birthday today. So happy birthday to you, Randy. Remember, with a name like Smuckers, it's got to be good.
So coming up, we'll have a special report on collateral underwriter and credit scores. But first, let's hear from Arch Foundation.
Hi, I'm Sam Brockenopoulos. You may remember me from such Realtor Association committees as Realtor Lender, the Affiliate Committee, and Wiley Business Development Meeting. But today I'm here to speak to you on behalf of Arch Foundation Repair. Arch Foundation has been in town for a long time, based here in Dallas. There are 5 pillars, so to speak, quote unquote, of their business model. They never take any shortcuts. They offer a truly professional, comprehensive repair plan, not just throwing piers in the ground. Operating to the highest standards with their proven, powerful, permanent ProLift system. They also offer a lifetime transferable warranty that's backed up by the Texas Foundation Warranty Trust. So sometimes there's fears of what's going to happen to the company and whether this warranty will stay good. Arch is backed by the state warranty trust, so regardless of their existence in business, which should continue for some time, the trust will take care of any warranty issues. They offer specials for those in the real estate industry, including realtors, lenders, and those clients referred by either one. Special pricing, priority service, that lifetime transferable warranty we discussed. They also offer flexible payment options as far as taking care of the payment for the work done at closing from either party's proceeds when they can do it. And they'll work with you on those. They offer all repair types to all foundation types. I was looking at their website just last night. They have over a dozen pretty well-written realtor testimonials all over the website from realtors that are members of our association. So do them a favor and check out archfoundationrepair.com. Get in contact with them and take care of your clients, their needs, and any property issues you may have. Thanks.
Welcome back to Good Morning CCAR. Now a special report from our reporter in the field, Tish Ashanopoulos, about collateral underwriter. Tish?
Thank you, Scott. Hello, I'm Tish Ashalopoulos, and I am here today with esteemed appraiser Vaughn Krikorian. And we're going to talk about some of the changes to appraisals, appraisal processes, and Fannie Mae. So, Vaughn, what is collateral underwriting?
That's a very good question, Tish. Collateral underwriting is a proprietary appraisal risk management database that was developed by Fannie Mae, introduced in January 2015, with information they have been collecting since 2011.
Wow. Where does Fannie Mae get this information?
Collateral underwriting is built upon appraisal reports that are submitted every day from every lender and from every appraiser directly, and they data mine every appraisal.
Wow. What type of data are they capturing exactly?
The information that is found in collateral underwriting is the information that's found on the appraisal report. So when it talks about location, quality, condition, gross living area, room count, they are gathering information and to put into a statistical model.
Wow. What do they call their statistical model?
The statistical model, which the lenders receive back, is called a summary submission report. And it's an offshoot of the collateral underwriting, and it helps to risk rate every appraisal that is submitted to Fannie Mae.
What kind of risk ratings are they doing exactly? What's that come back as?
Well, Fannie Mae has developed a risk rating score on a scale of 1 to 5. Scores of 1s and 2s really are no major concerns to the lender or to the real estate communities. A score of 3 may put a small little hiccup into the appraisal process or into the loan process. A risk rating of 4 or 5 is going to require alternative action on behalf of the lender before we proceed with the loan file.
So if a lender receives an appraisal, and let's say it has a high score, which I'm hearing is a bad thing, 4.5, how does the lender best mitigate that risk on the appraisal?
Well, the lender has a lot of options that they can present. They are presented from the summary submission report, or commonly known as an SSR. They may go back to the appraiser and ask for further clarification of some of the questions that are that come about because of the SSR. Fannie Mae and or the lender can provide the appraiser additional comparable sales to look at and reanalyze. Also, the appraiser can take a second look, or possibly what's called a reconsideration of value. But also important is, just because a score of 4 or 5 may come on that does not mean the appraisal is a bad appraisal. There are other options that the business partner, which is the lender, may present to the realtor, such as converting that loan to an FHA loan.
That's right. We've been talking about Fannie Mae, and FHA does not have an equivalent system at this time to rate appraisals.
That is correct.
So legitimately, they could be flipped to an FHA.
Yes.
Interesting. So, is it true that an appraiser or an appraisal could make value only to be reviewed again by another appraiser in the presence of a high SSR rating and end up with a lower ending value?
Yes, there are very unique circumstances where that may occur. And for example, if the property is a super adequacy, there's limited sales data, it has a unique feature, maybe acreage, could be water view, it could be impacted by the airport. So there's a lot of mitigating circumstances that it has a high SSR score, and it's going to cause for an additional level of review, and there might be an adjustment on that value based on the statistical modeling that Fannie Mae will present back to the lender.
You know, I have heard that when Fannie Mae risk rates an appraisal like this, that they literally will supply what statistical models showed is the 20 best comps.
Yes, it's Fannie Mae's intention to provide a data pool of 20 sales, which are based on census tract, and expanding out from that census tract epicenter to identify those sales, up to 20 sales, which may be considered as alternatives in addition to what the appraiser has provided on the appraisal report.
So as an appraiser, how do you feel about this process and this new system? Do you feel that it enhances the quality of the information the lenders have? Or do you feel like that it is so statistically based that sometimes the truth gets lost in the data?
The answer to that is yes on both parts here. It's going to improve the quality of the information. It's going to keep the appraisal process professional. It's going to keep it clean. It's going to help remove bias, and it's going to help remove inconsistencies in the process. But at all times, I think it's very important for the real estate community to know there's always going to be a human being or an appraiser looking at this information and making a final determination as to what the process will proceed from that point.
Vaughn, thank you for joining us today and for sharing your expertise in this very important subject.
You are welcome, Tish.
This is Tish Ashanopoulos for Good Morning CCAR. Back to you, Scott.
Thanks, Tish.
So we're in a situation where there's potential, after an appraisal comes back, there's this potential for additional review to be required. And these other things, I've sometimes have borrowers whose agents recommend that they wait to order the appraisal until either the end of the option period or until all of the repair addendum have been negotiated, which can take, let's say, 7 to 10 days. And then we order the appraisal, and it's 7 to 14 days to get that appraisal in. That puts us at 24 days on our 30-day contract. That doesn't really give us any time for any additional action that may be required. So, is that the best course of action? Waiting to order the appraisal?
Sam, I think moving forward, we need to advise borrowers that best practice is probably going to be to just consider the appraisal and upfront costs like we do the inspection right now. So I think both the inspection and the appraisal need to be ordered concurrently. That's going to help with the time delays and make sure that the transaction gets closed on time. While I understand there's a fee for that upfront appraisal, you also have to advise the borrower that if they don't get closed on time, that earnest money is going to be at risk.
Now, we've all touched on this, but it's really important to repeat that if a desk review is required as a result of a high SSR score, that another week to the overall process could be added to and delay the closing. So it's also an additional cost to the buyer, and we just need to keep that in mind as we're going through the process.
So it sounds like the FHA process may not be such a bad thing after all.
Yeah.
Possibly not.
Here we are trashing Fannie Mae on one hand, trashing FHA on the other hand, and appraisals are going to be more strict for pretty much all loans all the way around.
Absolutely.
Yes.
All right, well now, let's go to the weather with Joe. Good morning, Joe.
Hey guys, I'm sure you've heard, as we spoke about, all the weather models have predicted there'd be a huge TRID storm that would have hit by August 1st and would be raining all over us at this point. But as you can see, it's beautiful and sunshine outside. Evidently, the TRID storm's stalled. We checked with the CFPB and they pushed their implementation of the procedures and disclosures back to October 3rd. The models predict the storm won't actually hit until at least Monday, October 5th. This is why we're predicting serious hail on loan applications just before midnight on October 2nd. Most of us seasoned weather lenders plan to be on site late that evening to bring you the coverage. After October 2nd, we may still experience some rogue winds, flooding, drowning, even death. But there's also a good chance the storm will just come through and clean up some of the financial streets that are still littered with the unprepared lenders and cloudy disclosures. I interviewed the REALTOR Lender Committee of CCAR, and those lenders welcome the new disclosures and are even calling them know before you owe.
So no reason to panic after all, right, Joe?
That's absolutely right, Scott. This is Joe Boganopoulos with Good Morning CCAR Mortgage Weather Report. Back to you guys in the studio.
You know, with TRID, lenders are going to have to start vetting title companies, the title companies that actually perform the closing, to ensure that they meet the requirements. So if a title company is not able to be approved by a specific lender, there's two things that can happen. Either the buyer is going to have to change lenders in hopes that that new lender will be able to approve the title company, or the title company on page 2 of the contract will actually have to change. But don't worry, because all of the quality title companies in this area are going to go ahead and be on everybody's list.
You know, I think you're right, Julie. You know, in addition to Dodd-Frank and TRID, the Graham-Leach-Bliley Act also burdens the lender with safeguarding their confidential borrower information. So it's very important that we work with those good, reliable title companies that have put in place the procedures necessary to protect borrower information. So, you know, some of the smaller companies may not have implemented those procedures. You see those companies where you can walk in the front door, you walk right past the receptionist, back into the middle of the title company, and you know, files are laying out on the desk. I can assure you the good title companies that we work with now are going to make sure that those procedures are in place. So I really don't think there'll be any problem there. But you can see why the lender has to be concerned with that information.
Well, and the good news is about the TRID changes, you know, early on there was a lot of fear and hesitation regarding how quickly a loan is going to be able to be closed. The changes in fees at the last minute that require a new closing disclosure and a new 3-day wait, and then another 3-day wait, and then another 3-day wait. And there were, you know, rumors and stories of 45 to 60-day closings. I think somebody put out the average is going to be 47 days. You know, there's really not a lot of teeth to that. We did find out over the course of the time when the rules were announced that changes in fees that'll require a redisclosure of that CD have to total an APR change of an eighth of a point or more, which in most transactions equates out to about a half a point in cost, which, you know, in the last couple of 3 days of the loan, to have a half a point in cost swing for or against the borrower are relatively rare. We should know that information ahead of time.
Well, we've always had those rules about TILA anyway, that if you had a big change in the APR, then you're going to have to redisclose and wait. So this really isn't new, is it, Sam?
It's not.
So it goes back, it's not. It goes back to what I've been telling a lot of realtors as we talk about this, and that is choose wisely. Whether you're the buyer's agent or the listing agent, if you let your customers either choose contracts or go with lenders that are bad now, then they're probably going to be worse later. And conversely, if your customers are working with the good lenders of CCAR, then you shouldn't expect that there would be any more delays.
Exactly, Scott. And as we know, even today, we have situations where last-minute changes can delay closings. For example, when a realtor is giving a rebate to a buyer and it's not discovered until the HUD is provided at the closing or right before the closing, then that has a potential to delay the closing due to the appraisal is required to be updated to contain that specific rebate, and the lender must prove that that appraisal has been delivered to the buyer before anyone is allowed to sign the closing documents. So even with the TRID changes, we don't expect that many new delays that we don't already have. And everyone is just going to have to adjust a little bit in the beginning because there will be some glitches, but we'll all work through it.
Absolutely. And you know, I'd like to point out that TAR and TREC are both working very hard on behalf of the realtors. The new forms are coming out, and as I understand, there is a 10-day grace period for closing built in, but that only applies to the TILA delays. So still very important to get the appraisal ordered on time, make sure the borrower gets the documents in on time, because those delays will not be receiving the grace period. And again, that earnest money could be in jeopardy.
So Don, will it weed out the bad actors?
Scott, from what I see, most of the bad actors are too big to fail.
All right. Well, after the break, we'll hear about credit. But first, a word from North American Title.
Hi. I'm Mary Carmen Kelly, Business Development person for the Allen office at North American Title. Before I get started, I want to thank Scott Moyes, who's the president of our company, for coming. Everybody say hello, Scott. My office is, like I said, in Allen, and we are located on Waters Road between Bethany and McDermott. So it's fairly close to Plano, pretty convenient. And we have 2 closers and 1 assistant in our office. It gets a little bit confusing sometimes because both of our closers are named Donna, and their last names both start with H's. So a very common question in our office is Donna Hunt or Donna Holiday. So it's pretty comical, but we make it work, and they are both very, very knowledgeable when it comes to title. We have a very experienced people working in our office, as North American Title always they always hire the most professional and knowledgeable people. So I handle the north part of Plano, as well as McKinney, the east part of Frisco, and Allen, of course. So we can shop underwriters. We can, North American Title can close using 7 different underwriters, which is a huge, huge deal for us. It certainly makes it very nice and convenient should something pop up on a title work that we do, okay? One of the things that makes us unique among our competitors is we give back to our customers at closing. Every buyer and seller that closes with North American, whether it be a purchase or a refi, will get a 1-year identity theft repair protection with a company called All Clear. So we like to make sure that our customers know that we take identity theft protection very, very seriously, and that's just a thank you gift to them for closing with us. So well, that's just a thank you, and they love that. So they get that for 12 months from the date of closing. They get a little card. Should something happen, a credit card gets stolen or a purse gets stolen, they just call the 1-800 number, and All Clear returns their policy back to normal. So that's a great, great add-on. We are huge on customer service. I personally will pick up contracts at agents' offices, earnest money as well, and I will do whatever it takes. Those of you who don't know me personally, I have a background in real estate. I sold real estate for 14 years before I came over to the title side, so I do understand what goes on in the real estate business, what it takes for you guys to close those deals. So I will do anything that you need me to do. I'm more than happy to do it because I care, and Jennifer as well, care about everything that you guys go through. So we are huge on customer service. We will also do courtesy closings. If Allen or our Plano office is not a convenient closing for your buyers or sellers, we will go to you. Whatever you guys need us to do is what we are willing to do for you, okay? And with that said, I'm going to hand it over to Jennifer Gerlich, who is our Plano Business Development Rep.
Hey guys, she clearly is the better speaker out of the 2 of us, so I'm just going to introduce myself, Jennifer Gerlich with the Plano office, like she said, at Preston and Parker. And we just want to say this: we understand that we are a reflection of you guys. And at the end of the day, your clients, the last step is the title company. And so if we don't do our job, we're a reflection of you. So, we appreciate your business, and, thank you.
Welcome back to Good Morning CCAR. Now we're going to watch a report from CBS News and our friend Katie Couric that was recorded in 2008.
Continues our series, Life and Death in America. 7, so she's going to take 7.5.
Like most Americans, Louis Hobgood and his wife, Dina Skinner, can't live without their credit cards.
Figure your feet inside of the shoebox.
I use credit probably every day. It's just becoming such a way of life, you know.
And as we all try to keep track of our spending,
This is 30 days past this new Rashid's tuition.
the debt industry is keeping track of us.
This is the space that houses all of the data that we process.
This corridor in a Minneapolis office building
We're headed into the data center.
goes to the heart of the most sophisticated credit system in the world. A heavily guarded web of wires where your FICO score is calculated. Named for the Fair Isaac Corporation which created it, the 3-digit number is used by banks, credit card companies, and mortgage lenders to determine whether you get a loan and what interest rate you'll pay.
So what sort of information, about me would be in here? I mean, transactions I've made, loans I've got, whether I'm on time, that sort of thing?
Absolutely.
Drawing data from the 3 major credit bureaus, this system processes literally billions of bits of your financial information, like how much you owe, what you earn, and whether you're maxed out on your credit cards.
So if you're a lender today, you can get instantaneous information about the credit worthiness or the viability of a consumer's ability to pay back a loan.
Most of us use the bank. The speed of that technology has eliminated your local bank officer.
You have a good reputation. We know you're reliable.
And allowed the credit markets to explode.
And when we saw that starting to happen, we said, uh-oh, this is bigger than we ever imagined.
Mathematician Larry Rosenberger, using analysis that showed human behavior tends to be consistent over time, helped develop the FICO scores back in 1989.
They're not perfect, but they work with a level of precision that can't be gotten any other way.
The major credit card companies use the scores to judge hundreds of millions of customers.
It's a very controversial topic.
To decide whether to raise your interest rate or even close your account.
Most large credit card issuers will grade their customers once a month. The majority of the time, the consumer has absolutely no clue that it's being done.
But you can find out your score by going to myfico.com. It'll range between 300 and 850, with anything over 750 considered healthy.
What you calculate here has a lot of impact on people's lives.
Yeah, it does. On their financial lives, at least.
And it's made debt a booming business. Anthony Mason, CBS News, Minneapolis.
You know, that is a great video and certainly very relevant even in today's marketplace. You know, I get borrowers that call me almost daily, and when we go through the interview process, I ask them, how's your credit? And a lot of times they get, well, I recently went online and pulled my new credit score, and it's a 740. And of course, then when I pull it, it comes up a 680. And a lot of times if people don't, if you're lucky, a lot of times if people don't understand that there are actually 65 different scoring models available out there today.
And that's 65 different FICO scoring models, not to mention the other models. And each one has different requirements to maximize the score that's available. For instance, if you have installment debt or mortgage debt but have never had revolving debt, you're going to be limited on what kind of score you can get. I had a borrower a couple of months ago, his entire credit history was 3 car loans. And because he never had an ounce of revolving debt or credit card debt, because he didn't believe in it, quote unquote, his credit score is never going to be higher than a 680 as far as the mortgage report's concerned. And it's important to know that a variety of types of credit and utilizing them all is the best way to maximize your score.
I get asked all the time from customers about the new Vantage score that was created and when are lenders actually going to start using it. It was advertised as having much higher credit scores based on some of the more predictable models of today. Unfortunately, the GSEs, which are Fannie and Freddie, are still using FICO Model 7. It's very unlikely that they will ever spend the money to use any other model, especially when there are rumors that they're going to be merging or going away.
I like to compare going online and pulling your own credit score to kind of like going online and using Zillow to get the estimate of your home's value.
That resonates, doesn't it?
Yeah.
All right, so now let's talk a little bit about what you see out there in non-QM financing.
Well, Scott, let's first define what QMs is. QM stands for Qualified Mortgage. Its intention was to identify low-risk mortgages. It's defined as a loan that has loan points and fees that are less than 3% when the loan amount is $100,000 or higher. No risky features like negative AM, balloons, or interest only. The maximum loan term is a 30-year or less. And then, most importantly, a debt-to-income ratio that's at 43% or less. And in today's world, that would eliminate a significant number of mortgages. There is a temporary waiver through January 10th of 2021 that allows mortgages with higher debt-to-income ratios that are eligible to be sold or insured and delivered to Fannie, Freddie, FHA, VA, and USDA to be able to continue to be closed.
Well, I guess that's going to have to be my retirement date then.
For all of us.
Well, and the QM, non-QM loans rather, that are available out there, they're not bad loans. It just depends on the borrower. For instance, somebody who's relatively recently self-employed or has just changed jobs, even though they've been on the job or changed jobs within the same company, or changed compensation structure. And according to the agency guidelines, there's weight requirements for the length of time you've been receiving your compensation in a certain way. And if you want to go even further, any jumbo loan is considered non-QM, so they would all have a 43% cap as far as the debt-to-income ratio. Foreign nationals, for example, don't necessarily always meet certain agency guidelines, but are fantastic borrowers other than that. So the non-QM market is something that needs to be utilized. It's just a question of who can and who will.
Right. I do think it's very important to emphasize the fact that these are not subprime loans. These resemble more the alt-doc loans that we used to use. So for instance, to establish income, we may forego the tax returns and look at 12 or 24 months worth of bank statements. So those are the kind of loans we're looking at, not the subprime loan.
Yeah, I've actually seen some non-QM loans myself that it's interesting that they're offering these loans. They're not going to be sold to the agencies, so they're being securitized and sold or kept on somebody's balance sheet. But what I found was very interesting was that the interest rates on a few that I've looked at were 8% with 2 points. So it goes back to how badly do you want the mortgage? Your alternative then would be, I can pay cash.
Or I can wait.
Or you don't buy, right? So the non-QM is starting to come back, and I think that as we have more investors coming into the marketplace, then those rates will probably come down a little bit, but we all have to just keep in mind that if you're looking at doing your 12th financed property or 20th financed property, then if you want financing and you can't get it at a local bank out of their real estate department, then you might have to go non-QM instead. All right, so that's our show for today, Tuesday, August 11th, 2015. We hope you were entertained and informed. If you were, please let us know. And if you weren't, please keep it to yourself. And now, since we have a few minutes left over, we'll go ahead and open it up to any questions if you have any.